You did everything right. You saved, you planned, you retired, or you're close. And then Medicare sends you a bill that's nearly double what you expected. No warning, no explanation in plain English, just a larger premium because your income 2 years ago was too high. Most people assume Medicare Part B costs everyone the same flat rate. The data tells a different story. According to the Centers for Medicare and Medicaid Services, roughly 7% of Medicare beneficiaries, about 4.4 million people, pay an IRMAA surcharge on top of their standard premium. That surcharge can add anywhere from $74 to over $443 per month per person. Today, you're going to learn exactly what triggers that charge, how the 2-year look-back rule catches new retirees off guard, and what moves can legally reduce or eliminate that bill before it ever arrives. What IRMAA actually is, IRMAA stands for Income-Related Monthly Adjustment Amount. That's bureaucratic language for a Medicare premium surcharge. The idea behind it is straightforward. Higher income beneficiaries pay a larger share of Medicare's costs. Congress built this into the Medicare Modernization Act in 2003, and it's been quietly expanding ever since. Here's what matters. IRMAA applies to Medicare Part B, which covers doctor visits and outpatient care, and to Medicare Part D, which covers prescription drugs. It does not apply to Part A, hospital coverage, for most people. The standard Part B premium in 2025 is $185 per month. That's the number you see in most retirement planning projections. But once your income crosses a specific threshold, that number goes up, sometimes dramatically. The right move is to know your number before you enroll, not after your first bill arrives. And here's the critical piece. IRMAA is not based on your current income. It's based on your income from 2 years ago. That 2-year lag is the mechanism that blindsides people at the worst possible moment. The 2025 brackets, exactly where the surcharges kick in. Let me give you the actual numbers, because vague warnings don't help you plan. For 2025, Medicare uses your 2023 Modified Adjusted Gross Income, that's MAGI, to determine your IRMAA tier. MAGI includes wages, Social Security benefits, capital gains, IRA distributions, rental income, and most other taxable income. It's broader than many people expect. Here are the thresholds for individuals filing single. If your 2023 MAGI was $106,000 or below, you pay the standard $185 monthly premium. If it was between $106,001 and $133,000, your Part B premium jumps to $259.70 per month. Between $133,001 and $167,000, it's $370.20. Between $167,001 and $200,000, it's $480.90. Between $200,001 and $500,000, it's $591.60. And above $500,000, you pay $675.20 per month. For married couples filing jointly, those thresholds are roughly doubled across the board. The lowest surcharge tier starts at $212,001 in combined MAGI. Now add the Part D surcharges on top of that. At the lowest IRMAA tier for a single filer, Part D adds $13.70 per month. At the highest tier, it adds $85.80. If you're a couple, both spouses pay the surcharge independently. Do the math on the highest bracket. $675.20 plus $85.80 times 2 spouses times 12 months. It's nearly $18,250 per year in Medicare premiums alone, compared to $4,440 for someone at the standard rate. Individual variation matters here. Your filing status, your income sources, and even when you take capital gains in a given year can move you between brackets. The 2-year look back. Why new retirees get blindsided. Here's where the surprise hits hardest. Say you retired in 2024. Your income in 2024 dropped significantly. Maybe you went from $180,000 in salary to $60,000 in combined Social Security and withdrawals. You enroll in Medicare in 2025. What income does Medicare use to set your premium? Your 2023 income, the year you were still working full-time. So Medicare looks at that $180,000 salary, places you in a high IRMAA tier, and charges you accordingly, even though your retirement income is a fraction of that. According to the Social Security Administration, which administers IRMAA determinations, the look-back period is standard and applies to nearly all new enrollees. There is no automatic adjustment for the income drop. You have to take action yourself. We'll get to that in a moment. This is also why Roth conversions, large capital gain realizations, or required minimum distributions, RMDs, can push retirees into a higher bracket unexpectedly. A single large distribution in 1 year echoes through your Medicare costs 2 years later. My take is this: every significant income event in your late 50s and early 60s deserves a 2-year forward look at your Medicare exposure. It's not optional planning. It's basic math. How to appeal IRMAA when your income has dropped. The good news, the IRS and SSA have a formal process for this. It's called a life-changing event appeal, and it works. If your income in the most recent year was significantly lower than the year Medicare is using, you can file Form SSA 44. This form documents a qualifying life-changing event. Retirement counts. So does the death of a spouse, divorce, loss of income-producing property, and a few other circumstances. What does not qualify? Choosing to work fewer hours, investment losses, or a general drop in asset values. Here's what I'd do. If you retired recently and your income has dropped, file that form immediately. Don't wait. The SSA can recalculate your IRMAA using your more recent tax return or even an estimate of your current year income. According to the Social Security Administration's own guidance, approved appeals can reduce or eliminate your surcharge going forward, but retroactive refunds for months already paid are generally not available. The form itself is straightforward. You'll need documentation, a letter from your employer, a tax return, or a signed statement. If your situation is complicated, a partial year retirement, a buyout, a one-time severance, working with a fiduciary advisor who knows Medicare is worth the fee. Your filing status matters here too. Married filers who experience the death of a spouse may qualify under a different event category with different income thresholds. Income strategies that reduce your IRMAA exposure. I focus on Social Security and retirement decisions for the 50-plus crowd, and IRMAA is one of the most underappreciated levers in that conversation. Here's how people legally manage their bracket. First, Roth conversions done early, ideally before age 63, can shift future income out of MAGI. Roth IRA distributions are not counted in MAGI for IRMAA purposes. The IRS confirmed this treatment under the rules governing Section 408A of the Internal Revenue Code. If you convert traditional IRA funds to Roth in your late 50s or early 60s, you pay tax now, but you reduce the RMDs that would otherwise push you into a higher IRMAA bracket at 73. Second, qualified charitable distributions. If you're 70 and a half or older, you can direct up to $108,000 per year. That's the 2025 limit, per the IRS, from a traditional IRA directly to a qualified charity. That amount satisfies your RMD, but never shows up in your MAGI. It's one of the cleanest income reduction tools available to retirees who don't need all of their RMD for living expenses. Third, Be careful with capital gains timing. A single large sale of appreciated stock or a rental property can spike your MAGI in 1 year and follow you into a higher IRMAA tier 2 years later. Spreading gains across multiple tax years, where possible, keeps your MAGI smoother and more predictable. Fourth, coordinate when you take Social Security with your other income sources. If you delay Social Security and draw from a Roth instead during your early retirement years, you may keep your MAGI below a critical threshold. Once you turn on Social Security, up to 85% of those benefits are included in MAGI per IRS rules. That's a meaningful number to account for. One important caveat: these strategies interact with your overall tax picture, your state's tax treatment of retirement income, and your specific asset mix. The right configuration depends on your situation, but the default recommendation is clear. Start modeling your IRMAA exposure at least 3 years before Medicare enrollment. 3 years gives you room to actually move the needle. The IRMAA cliff and why $1 can cost you thousands. There's one more thing you need to understand. IRMAA is not a gradual sliding scale. It's a cliff system. That means if your MAGI lands at $106,001 as a single filer, $1 above the first threshold, you owe the full surcharge for the entire year, not a partial surcharge, the full amount. At the first tier, that cliff costs you an extra $74.70 per month in Part B alone. Annualized, that's nearly $900 for a single person, nearly $1,800 for a couple, triggered by a single dollar of income. At higher cliffs, the stakes are even larger. The data is clear. If you're within $5,000 to $10,000 of any IRMAA threshold, targeted income management is not optional. It's financially rational. A Roth conversion, a charitable distribution, or simply timing a capital gain into the following year can keep you on the right side of the cliff. According to CMS data, the 2025 income thresholds are adjusted annually for inflation, so these brackets shift slightly each year. Always confirm the current year numbers before making decisions. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. IRMAA is one of those costs that feels invisible until it isn't. The surcharges are real, the look-back rule is unforgiving, and the cliff structure means that a small income decision can carry a large price tag 2 years later. But the tools to manage it are real too. The appeal process works. Roth conversions work. QCDs work. You just have to know they exist before the bill shows up. If this video helped you see IRMAA more clearly, hit subscribe so you don't miss what's coming next. Next week, we're breaking down the 2020 6 catch-up contribution limits, the exact dollar amounts, who qualifies, and the new rules that change the game for people 60 to 63. That one's important. Don't miss it. What Medicare or retirement income question is on your mind right now? Drop it in the comments. I read every one, and I build future videos around what you're actually dealing with. This video may contain affiliate links. I only recommend tools I use personally.